Welcome back, students and scholars. In this fourth ASC 220 lesson, we are going to turn the rules into one complete reporting story. This is not a question video, this is a guided practical illustration where we move from operating performance to net income, then from OCI to AOCI, and finally to total comprehensive income. Think of this as the episode where the accounting characters finally meet each other in one scene. By the end, you should be able to explain the full flow clearly. Net income shows earnings, OCI adds selected non-owner equity changes, and AOCI stores the history. Meet Northbridge Components Incorporated, a fictional industrial manufacturer created only for this illustration. The company reports for the year ended December 31, 20/5. All amounts are in thousands of dollars and the tax rate is 25% for both ordinary income and OCI items. Northbridge is fictional, so thankfully no real accounting team had to survive this reporting package, but the logic we apply is absolutely real and very useful for exams and professional work. Our learning route has 4 steps. First, we build net income from sales, cost of sales, operating expenses, interest, an unusual item, and tax. Second, we identify OCI items and calculate the net of tax effect. Third, we update AOCI in the equity section. Fourth, we combine net income and net OCI to present comprehensive income. Keep this route in mind. Build earnings, add OCI, update equity, present total performance. That is the practical path of ASC 220. We begin with the income statement base. Northbridge has net sales of $2,400,000. Cost of sales is $1,440,000. So gross profit is $960,000. The calculation is simple. 2,400 minus 1,440 equals 960. This also gives a 40% gross margin. Before we discuss OCI, we need a strong income statement foundation because comprehensive income does not rescue a weak calculation at the top. Next, we move from gross profit to operating income. Northbridge has operating expenses of $500,000, including selling, general, and administrative costs. Gross profit of 960 minus operating expenses of 500 gives operating income of 460. This is the core business performance number before financing costs and special items. Operating income may not sound glamorous, but in analysis, it is like the engine room of the business. If the engine room is weak, the rest of the story needs careful attention. Now we complete income from continuing operations before tax. Northbridge has interest expense of $40,000 and an unusual environmental cleanup cost of $60,000. Notice the presentation point carefully. The unusual cleanup cost remains inside continuing operations. It is not treated as a discontinued operation and it is not placed in a special category outside earnings. The calculation is operating income of 460 minus interest expense of 40 minus unusual cleanup cost of 60, giving pre-tax income of 360. The final step in net income is tax. Northbridge applies a 25% tax rate to pre-tax income of 360. That gives income tax expense of 90. After deducting tax, net income is 270. This is the bottom line of the traditional income statement. But under ASC 220, this is not the end of the performance story. Net income is complete, but it is also the bridge into comprehensive income. Now OCI enters the story. Net income captures revenues, expenses, gains, losses, financing costs, unusual items, and tax that flow through the income statement. But some recognized changes bypass net income and go to other comprehensive income. These are not owner transactions and they are not ignored. OCI is not an accounting black hole. The items are visible, reported, and tracked. They simply travel through the equity route instead of the earnings route. Northbridge has 4 OCI items before tax. First, a foreign currency translation gain of 32. Second, an unrealized gain on available for sale debt securities of 48. Third, a cash flow hedge loss of 20. Fourth, a pension liability cost of 12. Gains increase OCI and losses reduce OCI. Each item comes from a different accounting area, but ASC 220 gives us the presentation system for bringing these pieces together. Now we deal with the reclassification item. During the year, Northbridge sold part of its available for sale debt securities portfolio and realized a gain of 8. That gain is recognized in net income when the securities are sold. But the same gain had already been sitting in AOCI from a prior period as an unrealized gain. If we leave it in current OCI and also recognize it in net income, we count it twice. Accounting does not allow the same gain to wear two identity cards at the same time, so we apply a negative reclassification adjustment of 8. Let us calculate OCI before tax. The gains are 32 plus 48, giving total gains of 80. The losses are 20 plus 12, giving total losses of 32. Then we subtract the reclassification adjustment of 8 because that amount has moved into net income. So the calculation is 80 minus 32 minus 8, which gives OCI before tax of 40. This is the clean structure. Gains minus losses minus recycled amounts equals OCI before tax. Now we apply the tax effect. The OCI before tax amount is 40 and the tax rate is 25%. The tax effect is 10, so net OCI is 30. Under ASC 220, entities may present OCI components net of tax or present them gross with one tax line. Either way, the tax effect must be clear. In Northbridge's case, the number that matters for comprehensive income is the after-tax OCI amount of 30. Now the full performance measure is ready. Net income is 270, net OCI is 30, therefore comprehensive income is 300. This is the broadest performance number in this illustration because it captures the total change in equity from non-owner sources during the period. A simple memory line is this. 270 tells the earnings story, 30 tells the OCI story, and 300 tells the full comprehensive income story. Now let us translate the calculation into statement presentation. In a combined statement of comprehensive income, Northbridge can show net income of 270, other comprehensive income net of tax of 30, and total comprehensive income of 300. This is the top level view. The detailed OCI components can appear on the face of the statement or in the notes. The reader must be able to understand both the total and the components behind that total. The OCI detail view explains how the 30 was built. The foreign currency translation gain of 32 becomes 24 after tax. The available for sale gain is 48, but after the reclassification of 8, the remaining before tax amount is 40, which becomes 30 after tax. The cash flow hedge loss of 20 becomes 15 after tax. The pension liability cost of 12 becomes 9 after tax. So the net total is 24 plus 30 minus 15 minus 9, which equals 30. Now we update AOCI. Northbridge begins the year with opening AOCI of 110. Current period net OCI is 30, so closing AOCI is 140. This amount appears in the equity section of the balance sheet as a separate component. It does not go into retained earnings. Net income flows to retained earnings, OCI flows to AOCI. Think of AOCI as a separate storage locker, not a junk drawer where everything in equity gets thrown together. At this point, students should see three separate concepts clearly. Net income measures the earnings generated through the income statement and drives retained earnings. OCI captures selected recognized changes that GAAP excludes from net income for now. A OCI stores the cumulative history of those OCI items in equity until they are reclassified or otherwise resolved. The formula is useful, but the meaning is more important. Net income is performance through earnings. OCI is selected performance outside earnings. A OCI is the balance sheet storage account. Let us protect ourselves from three common mistakes. First, do not post OCI to retained earnings. It goes to AOCI. Second, do not forget reclassification adjustments. If Northbridge ignored the 8 before tax reclassification, net OCI would be overstated by 6 after tax at a 25% tax rate. Third, do not ignore tax effects. These three mistakes can turn a perfectly nice calculation into a financial reporting emergency meeting. So keep them under control before moving to practice. Let us finish with the 4 numbers that define the Northbridge story. Net income is 270, net OCI is 30, comprehensive income is 300, closing AOCI is 140. If you can explain how each of these numbers was built, you understand the practical heart of ASC 220. In the next video, we will move to practice with MCQs and 8 short answer questions. Please like this video, share it with your colleagues, subscribe to Commerce Regiment and support the channel so we can keep building serious accounting education together.